What's up everybody, Genix Dividend Investor here. In this video I explore some key similarities and differences between dividend investing and bond investing in order to help you better understand ways to generate passive income. So whether you're building your portfolio or just seeking financial stability, this information will give you useful insights to make more informed decisions, and you should leave this video actually understanding what bonds are about. Now, while I asked who wins in the title of this video, the reality is that it's less about winning and more about what makes sense for your financial goals. It's kind of one of those blondes or brunettes decisions, i.e. both can be great or not, depending on what you're going for. I'll start with giving a quick overview of dividend investing, and then I'll go over bonds, and feel free to use the timestamp to jump ahead if you already know everything about dividends. So dividend investing involves buying stocks from companies that pay regular cash dividends to their shareholders. Dividends are typically a portion of a company's profits that they distribute to their share-owning investors. These are usually paid quarterly or monthly based on the number of shares you own. Companies that pay dividends often fall into categories like blue chip stocks, utilities, or real estate investment trusts, also known as REITs. So when you invest in dividend-paying stocks, you earn a return in two ways. Number one, through the dividends themselves, and number two, through potential stock price appreciation. Let's say you buy 100 shares of a company called ABC Corp at $50 per share. This means your total investment is 100 shares times $50 per share, which equals $5,000. We'll pretend that ABC Corp pays a quarterly dividend of 50 cents per share, so that means every 3 months you should get paid 100 shares times 50 cents per share, which equals $50. That means you should get $200 a year from your investment. Getting cash dividends are an example of passive income because you're getting money without doing anything more for it other than the original work you put in to buy the shares. One cool thing about dividends is that you basically keep getting paid the same amount regardless of what the stock price does. Like ABC's stock price could crash, or it could shoot to the moon, and you'd still get your $50 a quarter or $200 a year. The only way your cash dividend payout changes is if you buy or sell shares, or if ABC's board of directors votes to change how much they pay out, which most dividend-paying companies vote on once per year. Some great dividend-paying companies are known for increasing their dividend each year, and there are some companies that have paid increasing dividends for 50+ years. A key metric to understand is dividend yield, which is how much a company pays out per year per share in dividends, divided by the current share price. Like in our example, ABC pays out 50 cents per share per quarter, meaning they pay out $2 per share per year, and at a $50 stock price, that means their dividend yield is 4%. A way to think of that is that your original investment is getting a 4% return when you only focus on the dividend. So like the $5,000 you invested times 4% equals $200, which is what we manually calculated you'd be getting each year from ABC. But also remember that some of your potential return can come from stock price appreciation. Let's pretend that ABC is selling more of their products and their revenue is going up, and thus more people in the world decide that they want to invest in ABC, and that ends up pushing its price up to $60 a share. Assuming the company hasn't changed their dividend, then the yield at that point would be 50 cents per quarter or $2 per year divided by 60, which is 3.33%. That means if you bought more shares when ABC is $60, then you'd be getting a 3.33% return when looking at the dividend in isolation, again assuming that the company kept paying the same amount. Another key metric to understand is the payout ratio, which is one thing investors often look to gauge how sustainable a company's dividend payout might be. It's a measure of how much of a company's earnings are being used to pay dividends to shareholders, and is calculated by taking the total amount a company pays out in dividends per year divided by their earnings. So if a company has a payout ratio of 50%, it means the company is using half of its profits to pay dividends and is keeping the other half to do things like reinvest in the business. A payout ratio that is higher, like over 80%, often indicates that the company is returning most of its profits to shareholders, which could be unsustainable if earnings drop. A lower payout ratio, maybe in the 20 to 30% range, shows that the company is keeping more profits for growth and such, which might be good for stability, but offers less immediate income for investors. A moderate payout ratio in the 40 to 60% range is generally considered healthy, allowing for a balance between rewarding shareholders and reinvesting in the business. Note, some companies like REITs have their own version of a payout ratio, so don't use the standard formula. Now, some key advantages of dividends include: number one, dividends have the potential to grow over time if the company increases its payouts. Number two, you can reinvest dividends to compound your investment. Number three, some dividends have favorable tax treatment, such as qualified dividends in a taxable account. And number four, the companies behind the dividends are often names you'd recognize, like McDonald's and Microsoft and companies like that, which gives you pride of ownership, and more importantly, also means you can get stock appreciation over the long run. Dividends also have some potential downsides, including: number one, dividends are not guaranteed, as companies can cut or suspend them during tough times. Number two, the stocks behind a dividend can still be volatile, meaning your portfolio value can go up and down a lot, and those swings can be emotionally challenging for some people to deal with. Like if the market crashes, your portfolio value will also probably crash, even though your dividend payouts can't continue on as they did before. Number 3, you need to carefully research companies to ensure they're financially stable enough to sustain dividends. You want to guard against investing in something just because it has a high yield, rather than also digging into understanding if the company can keep growing and paying out a dividend. Okay, now let's look at bond investing, which are often seen as less risky than stocks. A bond is a loan made by an investor to a borrower, typically a government or corporation, that is repaid with interest. The issuer of the bond, aka the borrower, sells the bond to raise money and agrees to repay the principal amount on a set maturity date along with periodic interest payments to the bondholder. Like maybe a bridge or a school needs to be built, so some government entity will issue bonds for it. Or a company may issue bonds to get money to build a new manufacturing plant somewhere. Or maybe someone wants to build a new football stadium and thus they issue bonds to cover the bill. They might determine that each bond they issue should cost $1,000 and will pay a 3% annual interest rate for the next 10 years. That means if you bought 10 of those bonds for $10,000, then you'd get $300 in interest payments per year for 10 years, and then you'd get your $10,000 original investment back. And that's why bonds are seen as generally reliable passive income. In the bond world, they call the interest rate the coupon rate, and it's a fixed percentage. Speaking of stadiums, the NFL's Buffalo Bills just issued some bonds to build a new $2 billion stadium for themselves. They issued $5,000 bonds that they called Bills bonds and that are exempt from federal and state taxes, which means you wouldn't have to pay taxes on the interest payments you get. Take a listen to this 30-second clip.
The county opened up the opportunity for investors to help pay for the new Bills and stadium through tax-free bonds. The county comptroller's office says about 100 individuals in the county placed an order on a Bills bond totaling almost $3 million. After that, institutional investors placing orders for more than $200 million, well over the $125 million principal amount. That means not everyone who placed an order will get their bond. The deal closes on October 8th. It is then that investors will learn if they get their bond.
Those bonds are a way for fans and investors to help fund part of the construction costs of the new stadium, as well as get some sort of cash return. But one thing you've got to realize is that while you do get some interest and eventually your principal back, you never actually own any of the stadium, which is one key difference between bonds and dividend stocks. Like when I buy a share of Microsoft, then I effectively own part of Microsoft for now and hopefully forever. And because I own part of it, and because they pay dividends, that also means I get a small dividend payment every quarter from them. Anyway, I find it interesting that when you buy a bond, you're actually the lender in the transaction, and the bond issuer is the borrower. I mean, you're lending some other entity your money when you buy a bond, which is why they pay you interest and ultimately your principal back. But even though you're the lender in the transaction, it turns out that the borrower is the one that actually proposed the terms of the loan, i.e. the interest rate they're willing to pay, as well as how long they want to keep your cash until they pay the principal back. Now, normally if you wanted to borrow some money, let's say to start a business, perhaps $10,000, you might go to a bank to get a loan. You'd tell the bank about your proposed business venture, and the bank would look into your background and such, and then maybe might offer you a loan at a particular rate. But with bonds, it's more like you telling them the terms of the loan. Like, hey bank, I'll borrow $10,000 from you for 5 years, and I'll pay you 4% interest per year during that time. At the end of that 5 years, I'll pay you back the full 10% that I borrowed. The bank would then evaluate your offer, and if they think that you're reliable and 4% is a fair return, then they might agree to your terms. If they think 4% isn't enough for the risk of lending to you, they might decline your offer or ask for better terms, like a higher interest rate. And sure, loan discussions can be a give and take in real life, but I still found that interesting. Okay, so it's generally accepted that bonds tend to be a less risky investment than stocks are, on average, and thus also tend to have lower returns. For example, this table of asset class returns for the last 15 or so years shows that large cap stocks have returned the most at an annualized rate of 13.97%, then small cap has returned 11.3% annualized, then REITs are at 10.86%, then high yield bonds are at 9.12%, then international stocks are at 7.44% annualized, then emerging market stocks are at 6.93%, and then high grade bonds are down at 2.59%, with finally cash down at 0.85%. So TLDR, bonds tend to be less risky and also have less return, which is what you'd expect. But all investments, including bonds, have risk. Like one risk could be if the issuer of the bond defaults and can't pay back the principal. Bonds with higher default risk often come with higher yields, aka rates of return, in order to entice investors. The amount of risk depends mostly on the financial stability of the bond issuer. So like many governments are often seen as stable and safer bond issuers, so their yield is often lower. Corporate bonds often have a higher risk of default, so they usually offer a higher coupon rate. Low risk equals low yield, high risk equals high yield. Credit rating agencies assess how risky things are using ratings you've probably seen before like AAA, B-, etc. This can help any potential bond investors gauge the financial strength of the bond issuer. Another risk to consider is interest rate risk, i.e. interest rates can go up and any bonds you own are worth less if sold before the maturity date. As interest rates rise, more investors tend to want to move into bonds that provide safer returns with higher rates. I think of bonds as a straightforward way to earn a predictable income and are a popular choice for conservative investors and those looking to preserve capital. Hopefully now it makes more sense why bonds are called fixed income investments, which is because they typically provide regular predictable interest payments, known as coupon payments, to investors. These payments are fixed at a specific rate based on the terms of the bond and are paid at regular intervals until the bond matures. Classic financial advice recommends owning your own age in bonds as a percentage of your portfolio. So like a 40-year-old would own 40% of their portfolio in bonds, and the older you get, the more you'd shift into bonds more. I personally am 100% in dividend stocks, and I'm retired, but that just goes to show you that everyone has their own risk tolerances. I'd never advocate for my kids to own bonds, but that's just me. I'm sure smarter financial folks than me would say I'm too risky. Then again, you'd find smart financial people who'd say I'm not risky enough with my investments. That's why I encourage you to listen to tons of people and sources, and then do what makes sense to you. Okay, so what are some downsides to bonds? Well, number 1, bonds have limited growth potential as compared to stocks. Number 2, inflation can erode the purchasing power of the fixed interest payments you're getting. And number 3, bond prices can be sensitive to changes in interest rates, so like when rates rise, bond prices can fall. What are some other differences between divvies and bonds? First, in terms of income reliability, I'd say that dividend income depends on the company's performance and isn't guaranteed, whereas bonds provide fixed payments, which also isn't guaranteed, but are probably more predictable. Second, in terms of growth potential, I'd say that good dividend stocks tend to grow over time, both in terms of the dividend being paid out and the underlying stock they come from. Bonds can also actually appreciate on a secondary market if you try to sell, like if the issuer's financial health improves, or maybe if interest rates are falling, then existing bonds with higher fixed coupon rates become more attractive, so their prices tend to increase. Third, in terms of risk, I'd say that dividend stocks are subject to market volatility and company-specific risks, whereas bonds tend to be more stable, but can still have risks of defaulting by companies or even governments, and changing interest rates can impact both asset types. And fourth, in terms of tax implications, I'd say that qualified dividends are generally taxed at a lower rate than ordinary income, whereas bond interest is taxed as ordinary income, except for municipal bonds, which can be tax exempt. So how do you decide between dividend stocks and bonds? Well, dividend investing might be a better choice if you're looking for, number 1, long-term income growth, as dividends can increase over time, number 2, the potential for capital appreciation, and number 3, you have a higher risk tolerance and willingness to ride out market fluctuations. On the other hand, bond investing could be ideal for you if, number 1, you need steady, predictable income, especially in retirement, number 2, you want to preserve your capital and reduce volatility, and number 3, you prefer lower risk investments, even if it means sacrificing growth. Of course, you don't have to choose one or the other, as you can always take a balanced approach that combines dividend-paying stocks and bonds to have both growth and stability. So a young investor in their 30s might focus on dividend growth stocks and growth stocks in general, whereas a retiree in their 60s might lean heavily on bonds for their predictable income and capital preservation. Somebody in between or a balanced investor might allocate 60% to dividend stocks and 40% to bonds for stability. It really depends on you and your needs and risk tolerances. The next logical question is, how do you invest in bonds? And the easiest place is your brokerage. Probably the best way to gain exposure to bonds is to go with something like Vanguard's Total Bond Market ETF, ticker BND. I'll show you how to buy individual bonds in a moment, but ETFs tend to be better for the vast majority of folks. Bond ETFs tend to pay out interest through a monthly dividend distribution, while any capital gains are paid out through an annual dividend. Those sorts of ETFs can contain hundreds, sometimes thousands of bonds, making an ETF generally less risky than owning individual bonds. Of course, you can find all sorts of different bond ETFs out there, spanning corporate bonds, US Treasuries, municipal bonds, etc. I often like to see what Vanguard offers, but any of the big players out there has options to consider, and as always, you want to research what the ETF holds, what their specific costs are, tax implications, etc. But if you want to go down a path of buying individual bonds, which has its own risks, then you could search on your brokerage and you'd probably find something like this. This breaks down bonds by type and yield and time frame. So like it has US Treasury bonds, and if you wanted a 10-year Treasury bond, this says you could find something at a 4.39% yield. Or maybe if you wanted a 30-year bond from a AAA rated company, then you could click on this 5.19% yield option to see what they have. But before clicking on that, I already know that there are only 2 companies in the US that are rated that high, and that's Microsoft and J&J, both of which I own. Okay, let's click on it and see what it says. Sure enough, if you look through this list, you'll find that everyone is either J&J or Microsoft. So you can see the coupon rate for the first J&J offering is at 5.25%, and it would pay until June of 2054, i.e. 30 years. Going back, let's assume you're okay taking out a bit more risk and you want a bit more yield, so you click on a 30-year BBB rated corporate bonds, which are around 7% yields. Now I see some names I don't recognize, but there are also ones that I do recognize like Warner Media and such. So at the end of the day, dividend investing and bond investing both have their strengths and weaknesses. The right choice depends on your goals, risk tolerances, and time horizon. If you're just starting out, take the time to evaluate your financial situation, and you can always choose to seek out professional financial help if you feel you need it. And with all that being said, please leave me a comment telling me what percentage of your portfolio is in bonds and what percentage is in stocks. And if you learned anything in this video, or if you're just feeling kind, then please do me a favor and hit the thumbs up button, subscribe if you haven't yet, and click that bell notification, as all of that really helps. And now I'd like to shout out my latest Patreon aristocrat, Kate Denton, who just signed up. Thanks, I really appreciate it. Now I'll recommend checking out my Fast Graphs affiliate link along with my coupon code in the description of this video, as using both should allow new users to get 25% off their first payment even if they sign up for a full year. I'll also suggest that you try out my Seeking Alpha affiliate link, as new users can often get good discounts for signing up, and they have a special Black Friday sale running from now until December 3rd, 2024. Plus, take a look at my Patreon seats to see if there's any that you want to sign up for, but if those are sold out, like they often are, then please consider joining as a channel member, as it has a slew of perks I think you'd enjoy. Finally, don't forget to join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 83 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.